What immediately makes HumanCo interesting is your background. You're an ex-hedge fund manager. You worked for Steve Cohen. You built your own multi-billion-dollar firm. You quit the industry to make healthy food. Why a SPAC?
Why a SPAC? So I believe that there is a real shortage today of public options for fast-growing consumer companies that are trying to advance healthier over the last 10, 15 years from a lot of different institutional investors in mission-driven, socially responsible, and impact investing. And yet, even though this has grown exponentially, and now I believe it's in the hundreds of billions of dollars that have been earmarked for ESG and other investments that are similar, you still have a shocking lack of supply of reasonable options in the public markets. And we believe that right now is early innings. And given what we do at HumanCo today, and we've partnered with Cavu Ventures, which is a growth and venture equity firm that's focused on healthier living. We believe that today there is a large opportunity within the private markets to shepherd some of those really great private companies and bring one of them public through a SPAC, and that is why we created HumanCo Acquisition Corp.
Okay, so a supply-demand, if you like, a supply-demand imbalance. If we look backward, we can see the Beyond Meat IPO, for example, Jason, as an inflection point. But people who are looking at this space, we'll call it a space, health and wellness, may wonder to themselves, is there really room for more unicorns?
Oh, I think there's plenty of room. I mean, if you look at the health and wellness industry as sort of a whole, it's a $4.5 trillion market that's broken up into many subsegments. And even before COVID, this was the only segment of retail in the grocery store that was growing double digits. And now with COVID, all of those trends have accelerated. And so there's a lot of data to support in both the private markets and the public markets. Even if you look at many of the large public companies, the fastest growing segments of many of the big, large public companies within consumer packaged goods are their healthy and health and wellness oriented offerings.
So let me ask you this question, because you brought up consumer packaged goods. That makes me think of conglomerates. And the founders in health and wellness, by and large, are idealistic types. You yourself are something of an idealistic type when it comes to the importance and value of healthy food and healthy living. Those people don't want to sell to the conglomerates. They don't want to sell to private equity either. Why will they sell to you?
Well, I think some of them do. And I think it's probably unfair to brush all of the big public companies with that lens. There are some public companies that we feel are doing a terrific job of trying to move in the direction of more health and wellness offerings. There are a few conglomerates that are doing that. But what you said, I think, is right, which is that many of these founders are mission driven, and many of these management teams of some of these best private companies are mission driven, which means they really care about the philosophy, the ethos. They think about their legacy. They think about their probability of success. And so they really want to know who they're partnered with. And they want to know, does the partner that I'm choosing to partner with, do they walk the talk? Are they authentic? Do they actually understand why I, as a founder or a management team, why I am doing what I'm doing? And given my own experience of sort of wearing two hats for the last 20 years, one as a hedge fund manager for 20 years, and two, as someone who's struggled with many health issues over my life, and really built a sort of passion and philanthropic mission to help other people live a healthier life. My own personal story and how I've sort of worn both hats, we've noticed really resonates with many founders, because I understand where they're coming from and I understand what they're trying to do. And several other members of our HumanCo acquisition team on both the HumanCo side and the Cavu side also relate to them. And so
hang on just 1 second.
That's a big part of the driver of what will ultimately cause them to choose us as an option over necessarily selling to a large public company.
So the talent that you've put together, your partners at Cavu, the directors on your board, have expertise in a number of things, but one stands out. They're good at exits. What's the game plan here? Are you buying and selling a trade, if you like, or do you really plan to build something?
Well, I think, well, yes, we have had some good success with exits as a group. The plan on this is to build. And, if you think about what many of these management teams are doing and what they're thinking about, with our offering of the SPAC, teams are most likely not going to sell out most of their current equity. They're going to roll free. It's a $250 million fund. They're putting 10% of their fund free into, yes.
I just want to get one quick thing in before we finish, which is this. There are a lot of finance veterans with Wall Street connections who we might say are cashing in on the SPAC phenomenon. Are you different? And if you're different, tell me why, quickly.
Yeah, we are different. I mean, we are putting our money where our mouth is on this. We, as a sponsor group, put up 100% of the risk capital for the SPAC. As I mentioned, Cavu's putting 10% of their fund three in this. This is going to be the largest bet that HumanCo's making. And so we're married to this, and we're really looking at what happens after we de-SPAC with a target company. And plus, it's our legacy. And this is very important to me. I've devoted my whole life to health and wellness now. And so what happens after, we're not just matchmakers. What happens after is very important to us. And it's consistent with what we do every day.